The draft letter to fire the Fed chair is already on Trump's desk. Multiple White House officials confirmed he waved it in front of House Republicans in the Oval Office. And just as that shock was settling, Trump made a second move, one even harder to reverse. He ordered letters sent to over 150 countries, setting their tariff rates unilaterally. No negotiation, no debate. It's all going to be the same for everyone, he said. Except everyone includes countries like Taiwan, India, and Switzerland. Nations with billions on the line and no seat at Trump's table. But this isn't about those 150. This entire play was meant for one man, Xi Jinping. Because while the world was gasping over the mass ultimatum, Trump's team quietly gave China a break. In a stark reversal, Washington approved Nvidia's request to resume chip sales to China, just weeks after banning them under national security grounds. The chip being sold, the H20, was built specifically for China after the Biden-era export controls. The move reportedly aims to cap Huawei's market share, not eliminate it. "We're not selling our best chips," said Trump's AI advisor David Sachs. "We're just not handing Huawei the entire market." This nuance comes with irony baked in. The very market Washington seeks to contain is the one it just reopened access to. And this wasn't under pressure. Nvidia CEO Jensen Huang had already flown to Beijing to serve any company we are allowed to. That phrase alone, allowed to, tells you who's setting the terms now. But if this looks like surrender, it's not. It's calculus. Because according to data from China's Customs Bureau, exports in June rose 5.8% year over year, beating expectations. Total outbound shipments hit $1.8 trillion in the first half of 2025. Exports to the US dropped 10.9%, but exports to ASEAN up 13%. To the EU, up 6.6%. Washington is bleeding trade volume to other regions, and Beijing is accelerating, not collapsing. Meanwhile, Chinese GDP rose 5.4% in Q1, and economists expect 5.2% for Q2. The deflation crisis once predicted hasn't materialized, so Trump is trying something he hasn't before. Give China a limited win, so he can punish everyone else. Enter Scott Bessent, Trump's economic whisperer. He told Bloomberg, President Trump's able to create a lot of leverage because he's indifferent. If the EU refuses a deal, tariffs go up. If Japan delays, the letter applies. The contradiction is as strategic as it is erratic. Make peace with the US's greatest rival, then weaponize that calm to destabilize allies. The pivot is clear in June's trade directive. Canada faces 35% tariffs on select goods. Brazil, 50% across the board. Copper, pharmaceuticals, electronics, none spared. Even goods transshipped through Vietnam face a 40% penalty. This isn't trade policy. It's alignment warfare. But you know, the math has a blind spot. In 2024, U.S. companies earned about $1.2 trillion in revenue directly from Chinese consumers. That's actually 4 times the U.S.-China trade deficit. This covers sales of iPhones, 43 million of them. Fast food, with McDonald's having 6,820 locations. And honestly, everything from Gillette razors to Nike shoes. Trump may reduce imports, but exporting to China is really what props up the S&P 500. According to FactSet, about 7% of S&P revenue comes from Chinese buyers. That exposure is now a vulnerability. Should China retaliate with soft bans or push national brands, American companies could face a collapse in earnings. And, well, there's already a precedent. Take Starbucks. In 2020, it was neck and neck with Luckin coffee at 4,000 stores each. Today, Luckin has over 20,000 in China. Starbucks hasn't cracked 8,000, and it's already closing outlets. The lesson isn't about coffee. It's about consumer nationalism. Apple, Coca-Cola, KFC, they sell lifestyle, not necessity. And you know, when tariffs provoke sentiment, branding won't stop market loss. Yet instead of de-escalating, Trump is doubling down. Now, something no one saw coming. Equities surged after Nvidia's sales to China resumed. Nvidia stock alone rose 5% in a day. Investors took this as a de-escalation signal, ignoring the bigger signal underneath. Trump's policy isn't coherent. It's contradictory by design. While AI czar David Sachs praises the nuance, others like Jensen Huang are openly praising China's tech ecosystem. In Beijing, Huang noted 3 Chinese advantages: world-class AI software, expertise in mechatronics, and a massive manufacturing base for robotic scaling. This wasn't flattery. It was a forecast. Let's pause, because this isn't the trade war Trump promised. It's the tech war he's trying to stop without saying so. The US wanted to block Huawei. Now it's helping Nvidia compete against them. In China, it banned chips. Now it's granting licenses. Under export restrictions, it still claims to defend. It called China a threat, but its most powerful companies are begging to serve it. The contradiction isn't accidental. It's the only lever left. If the US cuts off sales, it loses revenue. If it allows sales, it fuels China's growth, and Trump's solution is to treat the rest of the world as expendable collateral. On August 1st, Trump's blanket tariff rates are set to activate. The new baseline 15% tariffs on all non-negotiated partners. Countries like Taiwan, Switzerland, and India have been warned. Some may still receive letters. Others won't even get that courtesy. This forces smaller economies to choose, accept US terms, or risk being locked out of the world's largest market. But the strategy isn't airtight. US consumers are already reacting. Retail sales rose in June, but only due to May's collapse, minus 0.9%, setting a low bar. The real test is August, when prices will spike and the base effect fades. And the tariff cycle isn't static. If the dollar weakens after Powell's potential firing, import inflation could exceed 25 to 30% in some sectors. Oh yes, electronics, pharmaceuticals, and auto parts are especially exposed. In turn, American families will pay more to buy less, while global suppliers shift towards self-reinforcing trade circles, BRICS and ASEAN included. But here's where the loop closes. Huawei's rise is partially fueled by US bans. By cutting off supplies, Washington accelerated China's self-sufficiency. Huawei now designs its own chips, and may export them soon. Sachs acknowledged it. Huawei is moving fast. They will export globally before they fully catch up. The attempt to freeze Huawei has become a catalyst for Huawei, and Nvidia, America's tech darling, is now the one playing catch-up in China. That alone should upend the narrative. China's rise isn't happening in spite of US restrictions. It's happening because of them. Beijing has used the constraints to deepen domestic capability, redirect exports, and now to become the world's most promising robotics hub. Even Bloomberg notes, any improvement in US-China trade may be temporary. The structure has shifted. And so, Nvidia's pivot to robotics is not just business, it's survival. There's no putting this genie back in the bottle. Washington's truce with Beijing expires August 12th. By then, the summit must be finalized, or tariffs will resume, possibly harsher. And yet, even if the summit is successful, it may only cement China's global position further. Beijing agreed to expedite rare earth shipments and open access to critical inputs, in exchange for the US lifting some chip controls. But each of these steps deepens China's importance to American supply chains. The contradiction at the heart of it all. The US is demanding strategic independence by increasing its strategic dependence. So where does this go? That depends on whether Trump actually sends the Fed firing letter. That depends on how countries like India and Taiwan respond to their tariff notices. And that depends on whether China even shows up for the summit. Because remember, Xi hasn't confirmed. Trump is courting China for stability, punishing allies for leverage, and authorizing chip sales to compete with a rival he helped create. This isn't the art of the deal, it's a game with no off switch. And it may already be too late to change the rules. But if you think Starbucks is the end of the list, you haven't looked at autos. General Motors and Ford have spent decades cultivating market share in China. GM still sells over 2 million vehicles annually in China, more than it sells in the US. The Buick brand? It thrives in China more than in Michigan. And yet, sales are sliding. Why? Because local champions like BYD, NIO, and XPeng are not only cheaper, they're exporting. Europe saw a 16% increase in Chinese EV imports in the first half of 2025 alone, according to Eurostat. In short, China is now both competitor and consumer, and the US is stuck in the middle, tariffing the supply chain it needs and the customer base it depends on. And here's where the loop snaps. US tariffs make American goods more expensive abroad, while making Chinese goods more competitive in non-US markets. Meanwhile, as Trump pushes his everyone pays doctrine globally, Vietnam is burning, metaphorically and economically. The 40% tariff on trans-shipped goods through Vietnam was intended to close a backdoor into the US market. But the backlash has been swift. Vietnamese firms are reporting canceled contracts from US buyers. And Bloomberg noted a 23% drop in textile exports routed through Hanoi since the tariff announcement. China, in turn, benefits again. With Vietnam crippled, Beijing's direct exports to Southeast Asia surge. China's exports to ASEAN were up 13% year over year, creating a circular system of trade rerouting outside of US influence. Every sanction seems to spin the globe one step further from Washington. Even in pharmaceuticals, the logic phrase. Trump has floated a 200% tariff on select pharma imports, largely aimed at countries like India and Switzerland. But the contradiction here is immediate. India produces 40% of the generics consumed in the US, according to the FDA. Swiss pharmaceutical exports, meanwhile, are dominated by firms like Roche and Novartis, who have massive US operations and clinical trial investments. A 200% tariff isn't just punitive. It's destabilizing to US health supply chains. And yet, the same administration is telling voters it's reducing drug prices. The numbers don't align. The timelines don't align. But the political momentum is overwhelming all internal contradiction. Let's now turn to the heart of American tech, Silicon Valley. While Nvidia tries to defend its China strategy under export compliance, other companies are caught in policy limbo. Applied Materials, Lam Research, and Intel all reported delays in export license approvals in their Q2 earnings calls. But Wall Street is betting the administration will blink because it already has. Consider this. In April, Nvidia warned investors it could lose $5.5 billion in revenue if chip sales to China were restricted. In July, it got partial clearance to resume sales. The message? Washington is posturing, but the market is dictating reversals. Still, that doesn't mean the risks are gone. China's tech stack is climbing faster than analysts expected. Huawei's chip subsidiary, according to Financial Times, is now testing 5-nanometer class chips for export by early 2026. That's not 5 years behind, it's less than 2. Huawei's AI division also recently unveiled Penguin Cloud, an LLM trained on Chinese-only data, optimized for Mandarin and outperforming GPT 3.5 in local NLP benchmarks. The product is already in use by state-owned banks and insurance firms. That's the new face of decoupling, parallel ecosystems, fully redundant, no longer seeking interoperability. But what about diplomacy? The summit between Trump and Xi is technically still on track, but with caveats. Chinese negotiators told Reuters that the truce agreement was, well, not a resumption of normalcy, but a tactical pause. Their condition for continued talks? The United States must guarantee no further escalations during the grace period, which ends August 12th. Yet Trump's team is already sending letters with effective dates of August 1st, a direct violation if interpreted literally. The contradiction? The US is trying to de-escalate China while escalating against 150 other countries, expecting Beijing to overlook that precedent. It's the diplomatic version of saying, you're different, you matter, but everyone else? They'll burn. Meanwhile, domestic policy cracks are showing. A leaked memo from the Commerce Department reviewed by the Wall Street Journal warned that blanket tariffs could increase core inflation by 1.7% in the third quarter alone. This while Trump is simultaneously pressuring the Fed to cut rates and stimulate consumption in anticipation of higher import costs. If both happen, tariffs and rate cuts, analysts from Barclays estimate the dollar could depreciate by up to 8%, compounding the price shocks. Trump's economic strategy, then, is chasing two goals in opposite directions. Inflate prices via trade war while suppressing interest costs via monetary expansion. That kind of tension doesn't resolve, it snaps. Here's a case in point. Taiwan. The island accounted for $122 billion in U.S. trade volume last year. It produces 92% of the world's advanced semiconductors, according to TrendForce. And yet, Taiwan has not received a tariff exemption letter from Trump. Sources in Taipei told Politico they're deeply concerned this signals a transactional pivot, where even key allies are being treated like adversaries. If the U.S. pushes tariffs on Taiwan, Beijing wins twice, politically and economically. Politically, it weakens Taipei's trust in Washington. Economically, it gives China the narrative of being a more stable partner in Asia, especially for neighbors balancing both superpowers. This is why ASEAN's behavior matters more than ever. Indonesia and Malaysia, for example, are increasing yuan-denominated trade settlements. The Asian Clearing Union recently added a China-backed regional settlement system that bypasses SWIFT. According to the Financial Times, yuan usage in cross-border ASEAN trade rose to 38%, compared to 24% just a year prior. This is the quiet financial migration away from dollar dominance. And it's happening not in the headlines, but in invoices. While Trump talks about fairness, other countries are adjusting to a future where American leverage is no longer reliable. So what's left? If tariffs backfire, if allies turn cold, and if China surges ahead, where does Washington pivot? One possible move floated in back-channel discussions: a multilateral rare earth alliance to undercut China's grip on critical minerals. But even this has limits. According to U.S. Geological Survey data, China still controls over 60% of global rare earth mining and over 85% of processing capacity. New projects in Australia and the U.S. won't close that gap before 2030. Moreover, China just announced export licenses are required for graphite, a critical battery input. That's a direct signal to Washington. We still hold the gate, and so the contradictions multiply. You can't decouple from your largest supplier and largest customer simultaneously without crashing your own market. You can't fire the Fed chair to goose the economy while raising import costs on 150 nations. You can't weaken the dollar to make U.S. exports competitive while creating domestic inflation via tariffs. You can't beg China for a summit while attacking its allies in Europe and Asia for doing the same. But that's exactly the position Trump has now placed the U.S. in. A circle of self-defeat disguised as leverage. Final twist. In a press event last Friday, a reporter asked Trump whether he believes Nvidia's outreach to China would undermine U.S. tech leadership. Trump replied, "They're doing business, but we'll have the last word." But that assumes there's still a conversation. Because right now, Jensen Huang is speaking fluent Beijing. And China, they're no longer responding. They're building. So the question isn't whether Xi will accept Trump's summit. It's whether he needs to. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.